The 401k is one of the most common benefits offered by employers in America, but is it as good as they say it is, or is the whole thing a scam?
You got scammed.
In this video, I'm going to be breaking down everything you need to know about 401ks, including what they are, how they work, and what are the key benefits that you might be looking for when you set them up, and what are my opinions about them as a seasoned tax professional. Make sure you stay all the way until the end of this video because I'll be revealing one crucial golden nugget of information about 401ks that people are very unaware of. Let's dive in. What is a 401k? A 401k is a type of retirement savings plan that is offered by many employers as an incentive to work for their companies that serves as a supplement to a salary. Now, the term 401k comes from the section of the US tax code that defines these types of plans and sets the rules for them. Some people make the mistake of thinking that the number 401 or that the letter K is somehow related to the specific investments that are made with the 401k, but they're not. It is just the tax code. Roughly 60 million Americans have 401ks, and 401ks make up roughly 1/5 of the 33.7 trillion retirement market. Other popular assets in this market include individual retirement accounts, known as IRAs, annuities, and defined benefit plans for government employees. How does a 401k work? The way that a 401k works is that when a person signs up for one, a certain percentage of each paycheck that they receive goes into the investment account for the 401k. Then, if everything goes well, the investments increase in value over time and the account grows year over year. Now, finally, after retirement, the person withdraws the money that is built up in their 401ks, either in the form of a lump sum or in installments, and he or she uses this money to help fund his or her retirement.
It's time to retire.
So essentially, the 401k is designed to help people to plan for their retirement and to be able to maintain their standard of living once they leave the workplace. Many employers will also match the contributions that you make to your 401k. This can be especially helpful for helping you grow the retirement account in your 401k faster. Now, there are two main types of 401ks. There's 401ks traditionals and there's 401k Roths. With the traditional 401k, the money is added to the 401k before income taxes are deducted. This means that the employee's taxable income is reduced by the amount of money that was deducted to put into the 401k. This results in a short-term tax savings due to a reduced annual income. However, people who have traditional 401ks have to pay taxes on the money that they take out of their 401ks in retirement. Now, with a Roth 401k, this is similar to a traditional 401k. However, unlike with a traditional 401k, the money gets added to the 401k after taxes are deducted. Because of this, there's no tax deduction in the year of contribution. However, there are no taxes required to be paid when you withdraw from this 401k later on in life. Some employers allow employees to choose between either the traditional 401k or the Roth 401k when they're setting up their retirement, and others do not offer any retirement at all. Now, contributions. When it comes to contributions, employees can make an annual contribution to the 401k up to the limit set by the IRS. For individuals, this will be $20,500 in 2022. The total limit for contributions made by the employee and the employer together is $61,000. So, if your employer offers 401k contribution matching, then it can be significantly easier to grow your 401k quickly. However, even if your employer does not offer 401k matching, you can still grow your 401k steadily by maxing out your contributions or contributing as much as you can each year. So, are 401ks a scam? Now that we've gone over some of the key details of 401ks and we have explained how they work, we're discussing the tax advantages of them, let's talk about why some people feel that they are a scam. Some employers pay their employees less when they are matching 401k contributions. Obviously, if an employer just lowers your salary by the amount that they're contributing to your 401k, then this could seem like a scam, right? The reason is because you might be thinking that you will be getting extra money by having a 401k. But if the employer just lowers your salary, then you're not really getting extra money. So, some people view this as a sort of false advertising or a scam when employers do this. Many companies won't match your 401k contributions until a vesting period passes, which is common for vesting periods to take place over 4 to 6 years. This means that you won't be able to get access to the 401k matching contribution for more than half of a decade in many cases. This is another thing that tends to irritate employees and makes them feel like the 401ks are a little scammy-ish or perhaps even a trap.
It's a trap!
This is especially true considering that the average employee only stays with the company for a period of 4.1 years. The fees for 401ks cuts into a lot of profits, despite the fact that a large portion of the people who have 401ks have absolutely no idea how much they pay in fees. So you see, 401k fees still definitely do exist, and they're more significant than many people realize. In fact, most 401k administrators charge between 1 to 2% per year. This may not seem like a lot, however, it is when you consider the fact that the average 401k only generates 5 to 8% in profits per year. So what this means is that the 401k fees could actually eat up as much as 40% of your returns or even more per year. This is extremely important to be aware of. Over the course of an entire career, depending on how much you make, this could translate to tens or even hundreds of thousands of dollars or more. Now, you are penalized if you try to access your money before retirement. Usually the penalty is 10%. So let's just say that you were short on cash, but then you wanted to take a little bit of money out of your 401k to fund a down payment for a new house. If you did this before reaching the age of 59 and 1.5 years, then the IRS would force you to pay a $5,000 penalty for doing so. The fact that you are penalized for accessing your own money early is another reason why a lot of people think that the 401ks are a little bit scammy-ish. Now, let's talk about inflation rates. Currently, they're higher than the average return for 401ks. This is relatively a new development, but in the last year or two, inflation rates have started to become higher than the average rate of returns for 401ks. So even if you're earning a 5 to 8% return on your money in your 401k, the inflation rate is currently at 8%. When you factor in 2% for fees, your real rate of return could be negative 2 to 5%. In other words, if your 401k is not generating you returns that are higher than the rate of inflation, then you could actually be losing money and losing purchasing power by having your money in the 401k, not gaining money at all. Many people don't realize that, and they're just sitting on a tax time bomb. A lot of people who have traditional 401ks think that because they defer the taxes until retirement, that they will actually save money in taxes. Therefore, they're caught by the surprise when they realize that they have an enormous tax bill to pay when they go to cash out their 401ks in retirement year over year. So many people who were expecting tax savings and then don't get them when they retire and cash out feel like they have been scammed by their whole 401k. My personal opinion of 401ks, I personally do not think that 401ks are a scam. I believe that when they are used correctly, they can be an effective way to save for retirement. However, this doesn't mean that I believe that they are perfect. For example, the fact that the fees are so high and that the returns are not currently higher than the rate of inflation is a problem right now. After all, if your purchasing power is dwindling faster at a higher rate than your 401k account is growing, this is a bad situation. But inflation rates are not always this high. We know that. In fact, for most of the last 30 years, CPI inflation rates have been below 3%. The Federal Reserve is actively fighting inflation right now by raising interest rates and doing whatever they do. So inflation could drop in the coming months and years if the Fed keeps this up. If inflation drops, then the returns of 401ks will have more weight. As far as like the 1 to 2% fees for 401ks, these are unlikely to go away anytime soon, but for many people, they're still worth it to pay. As far as taxes go, 401ks do not really offer a ton of tax advantages. Yes, you can defer paying taxes on them until retirement if you go with a traditional 401k, but you'll still have to pay them eventually. If you would prefer to not pay taxes on your 401k when you withdraw it, you can simply choose to go with the Roth 401k. But in my opinion, if you want to understand the true value of the 401k, you have to look at it from a broader perspective. 401ks, let's talk about the bigger picture. 401k is not just an investment vehicle, it's a budgeting tool. The 401k actually helps people to be financially responsible and safe for retirement. Considering the fact that 35% of US adults have zero retirement savings, the fact that the 401ks help people to allot money for retirement savings is actually a very helpful thing. Now, another thing to consider when evaluating the benefits of 401ks is the alternative to 401ks. One of the biggest alternatives to 401ks, and one thing that many people choose to do with their money, is simply leave it in a savings account. The average interest rate for a savings account in America is currently an abysmal 0.13%. This is so low that it barely even exists, okay? Because the interest rates on savings accounts in America are so low, it means that you will not be able to grow your account very well over time with a savings account, and you will not be able to benefit very much from the power of compound interest. So, just to put this into perspective, because the average returns for 401ks are around 7% per year, this means that returns for 401ks are roughly 53 times higher than they are for savings accounts on average. So if your goal is to grow your retirement savings, and to let the returns compound year over year, then a 401k is definitely the better option compared to letting it sit in a savings account, as long as you can be patient enough to not withdraw the money until you're 59 and a half. IRAs, or individual retirement accounts, are another option that many people choose to go with when it comes to retirement planning. And just like with 401ks, IRAs have a traditional and a Roth option as well. The option that you choose will determine whether your money is taxed in the current year or whether you're going to be taxed when you retire. IRAs have certain disadvantages. For example, IRAs have lower contribution limits. This means unlike 401ks where you can contribute up to the $20,500 per year, with an IRA you can only contribute up to $6,000 per year. So if your goal is to maximize your contributions, then a 401k is definitely a better option than an IRA. Let's go over some other ways to save for retirement. In addition to 401ks, IRAs, savings accounts, there are a number of other things that you can do to save for retirement. Here are some of the most common ways that many people save for retirement outside of 401ks, IRAs, and savings accounts. Number 1, real estate. Owning rental properties is a great way to prepare for retirement. There are a number of reasons why it is true. For example, real estate produces passive income that you can use to help fund your retirement on an ongoing basis. Real estate also tends to appreciate in value over time. In recent years, real estate has been appreciating by an average of 15 to 20% in America, meaning that it has been generating even better than 401ks. However, it does not always appreciate that much. 7 to 10% annually is more common. Real estate also provides great tax advantages, such as being able to deduct depreciation or being able to avoid capital gains taxes when you sell one property and you buy another like-kind property through what's called a 1031 exchange. Additionally, real estate is a great hedge against inflation. So if you have the means, real estate can be another great way to help you prepare for retirement. You should consider using real estate as a supplement to an IRA or a 401k. Annuities are another financial instrument in which people pay a monthly payment for a period of time or pay a lump sum payment to an annuity provider. Then he or she receives passive income from the annuity during his or her retirement. Annuities provide a great guaranteed stream of income, which is highly beneficial for maintaining some financial stability during retirement. And you can also look into cash value life insurance plans. Cash value life insurance plans are a type of life insurance in which the cash value of the plan builds over time. As you pay premiums throughout your life, you get access to cash value throughout your life. The insurance provider takes your money and he invests it, growing the cash value of your plans in the process. In addition to providing the cash value component, these plans also offer the death benefit, which you're pretty familiar with, which means that a substantial amount of money is given to your beneficiaries if something were to happen to you. This means that these plans can not only help to take care of you during your retirement, but they can also help take care of the people you care about after your passing. Let's talk about pensions. Pensions are a type of defined benefit plan. They're designed to replace a portion of an employee's income after he or she retires. Usually they replace around 30 to 40% of an employee's income in their life. Pensions are an extremely great way to earn retirement. However, they're becoming increasingly rare as lifespans increase. This is because it can be a major financial burden for a company to continue to pay its retired employees all the way until their death. In fact, only about 14% of Fortune 500 companies now offer their employees pensions as a retirement planning option. This is down from 59% in 1999. Pensions can be enormously beneficial, but it can be risky to depend heavily on them for retirement. This is because if the company goes out of business or the pension collapses for some reason, you could lose access to the payouts in the middle of your retirement.
No, God, please, no, 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 no!
All right, now let's talk about crafting your retirement strategy. The last thing that you would want to do is to not think about retirement and avoid creating a retirement strategy that could help secure your financial security in your golden years. Instead, you should do what you can to create an effective retirement plan right now. At the very least, you should opt into your employer's 401k program if your employer provides this option. If your employer does not provide this option, or if you are self-employed, you can still get into an IRA or you can still get into a solo 401k. I also highly recommend using multiple retirement planning tools if this is possible for you. For example, you can have a 401k and an annuity and a cash value life insurance plan. The more you have, the better prepared you will be for retirement. The average life expectancy in the United States is currently around 76 years. This means that if you retire around the age of 60, you could still have about 16 to 20 years left of life you have to finance. Okay, so it's far better to be prepared for this period of time in your life than it is to be unprepared. Now, unfortunately, many people have to return to work after they retire because they run out of money because they improperly planned. Yes, Social Security can help, but it's usually not enough to live off of for most people. So keep that in mind if you're thinking about banking on Social Security. Now, you need to be prepared for this golden nugget that I want to share with you guys. You made it to the end of this video, and so as promised, I want to make sure that I provide you guys a golden nugget of information about 401ks, and here it is. If you have a 401k with a company, and if you leave this company before you retire, it is a mistake to withdraw your 401k because you'll be hit with all kinds of penalties. Instead, you should roll your 401k over to your new employer's retirement plan or to your own IRA account. If you roll your 401k over in this manner, you can escape the penalty fees, the taxes associated with the 401k funds maximized. Okay. That's it for this video, guys. As always, don't forget to like, comment, subscribe. Also, we are launching the Tax-Free Wealth Challenge. If you're looking to spend 5 days with me to go over advanced tax strategies, I look forward to teaching you. Please click on the link below to join the Tax-Free Wealth Challenge and choose VIP so I can learn a little bit more about your situation. I look forward to seeing you on there. That's all for today's video. Cheers.